Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today I'm going to be talking to you all about commercial leases. So, wow, I mean, what a way to start. Are you scintillated, excited by that? Well, honestly, you should be, because I might be a bit of a nerd, but actually commercial leases are the cornerstone of creating value from commercial property. And if you understand that, and you understand how you can do paper-based asset management exercises to increase the value in commercial property, honestly, you are halfway there with your commercial property investing. So I'm going to talk to you today about an overview of what you need to know about commercial leases so that you can really get going and understand this. Now, the very first thing I think to say is we need to understand how commercial property is valued so that we can understand why commercial leases are so important. So commercial property is valued. It's not valued like residential for a start. So if you think about, if you're a residential investor, if you think about how you add value to residential property, what you're doing is you are taking a property that's probably needs some physical works doing to it. Maybe that's kind of ripping out the kitchen, the bathrooms, reconfiguring the space. You know, if you're creating an HMO, you might be creating more rooms. If you might be doing an extension, but you're doing, everything is physical. Everything is physically making the space larger. It's making it look better. And the reason for that is that residential property is valued on bricks and mortar values. So you are looking at comparable evidence of bricks and mortar, as in, you know, the value of the property as it looks and what the demand will be for that. So if you do a big refurbishment, it looks great, then obviously there's going to be more demand for it. That's the way things work, and you can charge a higher price from it, the basic law of economics. So that's how you add value to residential property. Commercial property is totally different. So the way you add value to commercial property is that you are basically trying to add rental, and you're trying to reduce the risk. So why is that? Well, you don't value commercial property the same way as residential. You're not looking at it on a bricks and mortar basis. The way you value commercial property is you apply a multiplier or a yield to the rent that's being generated on the property. So, for example, if you have a rent of £10,000 a year, and it's a secondary property in a decent town, you might be looking at an 8 or a 9% yield on that. The yield is the multiplier. It's basically the measure of the risk. So a valuer will look at comparable evidence, and they'll kind of assess the subject property against the comparable evidence. So they'll apply this multiplier or this yield to the income on the property, and that is how you derive the valuation. Now, you'll notice that that's not bricks and mortar. That's not how it looks. It's about how much money you're getting from the property, how much income. And the more rent you get, the higher the capital value. That's the way the equation works. So the name of the game with commercial property is to be adding as much rent as possible, adding as much income as possible, but also trying to reduce the risk, because the lower the risk is, basically the better this multiplier is going to be. So let's talk about this multiplier. Let's talk about this yield. So I'm really aware, by the way, that I'm going into the depths of commercial valuation, but there's a reason. So I'm going to come out of this in a minute and talk to you about commercial leases. But yeah, if you apply this yield, this multiplier, basically, valuation is an art, not a science. So what valuers will do is they will look at comparable yields in that market for that type of property, that size, that configuration, that location. Location is super important. They'll look at the sector that property's in. Is it a growth sector? Is it shrinking? What's supply and demand like in the area? But basically, this yield, this multiplier, is called the all risks yield in its really simple form. And what that is, it's a bundle of all the risks associated with it. So really simply, what a valuer will do using their expertise is they'll look at comparable evidence and they'll say, this property is risky because it hasn't got a lease on it. So therefore, there's risk of voids, there's a big void, there's risks of costs being incurred by the landlord. They'll also maybe say this is in a secondary retail pitch when there's loads of vacant properties, and therefore that's potentially an issue as well, because there's not going to be that many tenants to take this space, and there's lots and lots of supply, so that's going to be challenging too. So it's basically this yield, this multiplier, is a bundle of all the risks, and that's what the way that a valuer will look at it. Now, a commercial lease is really important part of that equation, because the absence of a commercial lease means that you're not getting income on the property, and therefore both sides of your equation for your valuation are being affected. So you're not getting rent coming in, and also there's higher risk because you've got a vacant property, and so therefore the landlord's having to incur business rates and utility bills and whatever else there is. Now, this can really play to our advantage as commercial investors, because what we want to do is we want to add value to property, create value. Now, obviously, you can invest in commercial property and just buy for yield. You can, buy a property with a long lease. But that's also looking at the lease. So the two ways you can buy commercial property, number one is you can buy for yield. You can basically buy a property with a really great tenant in place, let's say a food store, or a blue chip covenant, and they might have a 10 to 15 year lease or maybe longer, and you're basically buying that income for that period of time at maybe a 6 or 7% yield. Now, that is really important with regard to a lease, because the reason that you're buying that income is because a lease governs the occupation of that tenant, and within that lease there's lots of clauses in there that are really important for governing investment value. So number one, there's the rent. It governs the rent, and it also gives the ability, more often than not, for upward only rent reviews every 3 to 5 years, usually 5 years. They may be on an open market basis. They may be index linked, but it basically makes the rent keep in track with inflation. There'll be user clauses in there. There'll be lease length. If there's a 15-year lease with no break clauses, then obviously that's security. So that the lease that governs that the tenant's occupation of the property in that case is super, super important. And then you are looking at the second way you can invest, obviously, is buying something and adding value to it. And, you can do physical works by reconfiguring space, making it smaller, making it larger. But the reason, or changing the use even, but the only reason you do that is because you're looking to increase your commercial valuation. And so therefore you're looking to improve the type of lease that you could get on that particular property. And again, it's all comes down to this commercial lease. It's all down to having the ability to get better income and get better lease terms. And really that comes down to getting a better tenant. So if you buy, for example, a big industrial property for which there's not much demand, but you maybe split it into 2.5 to 5,000 square foot unit, and that particular market had a lot of demand for that as a sweet spot, then maybe on the larger unit, which when it's not split, you might be able to get a 3 to 5 year lease. There might only be 1 or 2 tenants in the market, which means you have to kind of basically look for a lower rent. It's going to be, it's going to be a difficult investment. If you can split that unit up, then you might be doubling the rent. And, myself with my deals and my clients are doing this all the time. They're buying property, they're splitting it up, and they're not doing it for, like you would with residential, to make it look better. They're doing it because it means that they will get a better rent, they will get a better tenant, and they will get better lease terms. So this lease, it governs the tenant's occupation of the property, and it's vitally important. And it's the reason why you can do paper-based asset management for commercial property. And that's one of the beauties of commercial property, is that you can do this paper-based asset management because of the way that you value commercial. You're not doing it on bricks and mortar, you're doing it on a multiplier of income, and therefore the lease will govern that income when it's paid and the tenant who pays it. So let's dive a bit deeper into commercial leases, and let me tell you a little bit more about how they operate.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
So, in terms of commercial leases, there's different clauses that basically are included, and they're very standard. A lot of these clauses are very standard, and you can deviate from that. But remember that investors like to see standard lease clauses. There's a certain type of lease that investors really like, and that's a good long lease length, 5 yearly upward only rent reviews, whether they're index linked or open market. They like to see full repairing and insuring terms. And, really full repairing and insuring leases are like the holy grail of commercial property. And you can't always get them. Supply and demand definitely governs whether you can get a full repairing and insuring lease or not. If there's an area where there's a lot of supply and properties and it's a tenant's market and they're playing landlords off against each other, then you're going to find it challenging to get a full repairing and insuring lease. And from here on in, let's call them FR&I leases, because it's quite a mouthful. So FR&I leases are full repairing and insuring leases. So I definitely don't believe in passive income. I definitely would never advocate that to anybody. But if you have an FR&I lease, it's about as passive as you can get, because the tenant will basically occupy for the lease term. They will repair the inside and the outside of the property. They will pay the rent, whether that's monthly or quarterly in advance. And when it comes to the end of the lease, the tenant has to hand the property back to you in the same condition that they let it. So, if they haven't done repairs, there's wear and tear, etc., then they have to pay for that through a schedule of dilapidations. And, they can do the works, or they can pay you a lump sum payment for that. So it's really, this full repairing insuring lease is fantastic, because what it means is that you're really not doing anything during the tenant's term of that lease as a landlord. They're repairing, they're insuring. You might want to ensure that as the landlord, or recharge it to the tenant. And, if there's a bit of freak damage and their sign falls off, I've had this on one of mine, the sign falls off and they're straight on the phone to me saying, can you repair the lease? And repair the sign. You're like, no, look at your lease. Actually, your lease says that you're responsible for everything to do with the property, and they have to go off and do it. So the full repairing insuring lease, investors love it in the market. If you've got an FR&I lease, especially if you've got a long lease term, you're going to find plenty of people that want to occupy that, as long as you're in the right sector, the right location. So FR&I, obviously what the lease does, it governs the rent. So it tells you what the rent should be. It also tells you how you should review the rent, whether that's 5 yearly, 3 yearly, upward only, open market rent reviews, or index linked. It will give you the formula for that. And therefore, again, investors like it because you're keeping track with where the market is. Commercial property is very inflation linked because of these rent reviews. You've also got other clauses in there. So, for example, if you have a blue chip tenant, then that's going to really reduce the risk in your property because you've got a blue chip tenant that you're pretty much guaranteed will pay the rent. I know in COVID that wasn't quite the case, but let's assume that that blip is over. Obviously, if you have a secondary tenant, they're not quite as secure. So what you can do in leases, you can include a guarantor, you can put a rent deposit in, which is basically where the tenant pays you a sum of money for a certain period of time. To basically, in case they stop paying the rent, you can put personal guarantees in. So you must always do your checks and balances on tenants in terms of, checking their covenant. It's called the tenant covenant, their quality, because you want to make sure that if you've got a 5-year lease, a 10-year lease, that they're going to be around long enough to see out that lease term and they're going to pay their rent during that whole period. So you can put all these kind of whys and wherefores in the lease. There's lots of other clauses in leases, like obviously lease length is really, really important because the longer a lease, the longer the security of the lease. And therefore, the more attractive that is to investors, as long as the rent's at a decent level and there's a good tenant in place. Be really careful of break clauses, as tenant break clauses, because you will definitely come across this with agents saying to you, oh, it's a 10-year lease. And then you look at the actual lease document when you receive it and you see there's a tenant's break clause at maybe year 3 or year 5, or maybe there's different break clauses throughout the term. Now, what a valuer will do is they won't see that as a 10-year lease. If it's a tenant's break clause, they will assume that the tenant breaks the lease upon the first break clause. So basically, if there's a break clause at year 3, they will assume it's a 3-year lease. So be really careful of that, because agents sometimes, very often, agents are great, but sometimes agents won't read the lease and therefore they might not know about these break clauses. So you need to really ask for the lease document to check it, get an agent to check it, get a solicitor to check it as well, especially if you're not au fait and familiar with commercial leases. So lease length, super important. Check for those break clauses because that can affect, obviously, the security of the asset. If you think you're getting a 10-year lease and you're paying a full price for that, you don't want to be finding that actually it's only a 3-year lease because there's a tenant's break clause. And then you're looking at other lease clauses like repair obligations, like I was talking about, whether they're internal repair or full repairing and insuring. You're looking at alienation, which is basically whether the tenant can dispose the property, whether they can assign or sublet the property, and the kind of hurdles they need to go through to do that. It also governs landlord's entry into the property if the tenant's not complying with the lease terms, because that's really important. And that's a really important difference between residential and commercial. Because obviously with residential, you've got loads of hoops to go through and a court process to go through to get rid of a tenant that isn't paying rent. But actually, if a commercial tenant doesn't pay rent and you've got rights of entry, which most leases do, then obviously I would always recommend that you work with a tenant to try and resolve any maybe short-term difficulties they've got. But genuinely, if you think that they're not going to pay the rent, then you can actually send a bailiff in almost straight away and recover the property. So it's a lot easier in the commercial world to do that. So there's loads of other lease clauses as well, obviously, and sometimes there's unusual ones, but they're kind of the standard lease type clauses. Who insures, what the landlord can and can't do. Obviously, what the tenant doesn't want is for the landlord to be always at the property and always kind of sticking their nose in. So there's something called quiet enjoyment, which means that the landlord has to back off, has to arrange appointments with 24 hours notice or whatever it might be. So what the market will do is they will look at the quality of that lease and they will say, okay, that's a great 10-year lease to a good tenant, and therefore I'm willing to pay more for that property than if there's a really short lease, rolling break clauses or whatever it might be. And so that's why a lease is important. Now, these paper-based exercises you can do to add value, that can come about by means of changing the lease. So, for example, if you are if you're buying a property where there's a tenant in there occupying in there under a short lease, and you can actually specifically source that type of property. You can find on some of the tech portals like Searchland, Nimbus, Land Insight, you can actually specifically source for properties with short leases. And then, you can have a conversation with the tenant before you buy. How are you trading? How's business? Remember, it's always business tenants in commercial real estate. And do you want to stay? And I would always put some money in my appraisal to say, can I bung the tenant a bit of cash, using the technical term, to extend the lease maybe? Because if, for example, the tenant's got a 1-year lease and you manage to extend it to a 5 or a 6-year lease, or maybe longer, then that's going to be much more valuable in the market. And that's a very simple paper-based way of adding value, because you're basically generating less risk as a result of that. You could also do something called surrender, which is where, say, it's very common on retail properties where the tenant maybe historically has taken the whole unit and they've got uppers that they just don't use. You might say to them, look, do you want to surrender, basically hand back the upper parts to me, and then you can go off maybe and do some kind of other commercial uses or convert it to residential or whatever else, use permitted development. And then you can so they basically will surrender the lease back to you. Or if you've got a better tenant that wants to take the space, or you want to kind of reconfigure or refurbish the space, then obviously you can maybe do a whole surrender. The tenant could hand the whole lease back to you, and you could actually go off there and do what you want to do. I wouldn't recommend that unless you've got a back-to-back exit. And if a tenant does surrender the lease because they're not trading well, they'll probably have to pay you the rent up until the end of the lease. So you can definitely do this lease surrender as well. You can also look at reconfiguring leases, trying to take out awkward clauses. This is where commercial agents can really, really help you. If you have a vacant property and get it let, then putting just by virtue of putting a tenant in place, putting a lease in place, that can add massive value to the property, because bricks and mortar, vacant possession value, there's no income coming in. And obviously the way you value commercial property is you put a multiplier on income. So if there's no income coming in, that property is going to be worth a lot less. So if you can then let that property quickly, then there's the potential to add massive value just by virtue of putting a tenant in place, occupying under a commercial lease. So commercial leases, sounds a bit dry. I think a lot of people come to me and they think, gosh, I don't know where to start with commercial leases. You just need to get a basic understanding of how leases work, and more importantly, really, the effect they can have on the value of your property, because that's the name of the game. This is why commercial leases are really exciting, because if you can get the right lease in place, the right tenant in place under the right lease, then you can add massive value. And myself and my clients, we're buying vacant properties, we're getting them let, and we're almost doubling the value of our property. I've got other clients who are subdividing space, doubling the rents, getting a longer lease in place because there's more demand for that type of unit, and therefore, again, kind of doubling the value of their units, getting all their money out. And, that's the name of the game. Commercial property is all about supply and demand. It's all about tenant demand. Tenants, if there's good tenant demand, and this is where you need to do your due diligence before you buy, if there's good tenant demand, then the likelihood is you're going to get a good tenant with a relatively long lease. Relatively long lease for that market might be 5 years, but obviously that's a lot better than a 6-month rolling AST in residential, or rolling break clauses after a year. So you might get a 5, you might get a 10-year lease, and you'll get much better lease terms as well, maybe a full repairing insuring lease. So commercial leases, not a boring topic, actually quite exciting in terms of what it can do for the value of your asset. And this is one of the beauties of commercial property, in that you can do this paper-based asset management, and that's the name of the game.